In this course, you'll learn about option contracts, basic strategies and concepts, why we trade options instead of stock, and most importantly, why we prefer to sell options rather than buy them. Let's start off by working through the difference between stock and options, and we'll build from there. Owning a stock is a very fundamental and basic concept. If I buy 100 shares of stock, I know exactly how much I can make or lose based on movement in the stock's price. If the stock rallies $2, I could make $200 if I sold my shares right then and there. If the stock falls by $1.50, I would lose $150. There is no gray area when owning stock. It either rises and I make money, or it falls and I lose money. I can hold shares of stock as long as I want, and as long as the company is publicly trading, I can profit from owning shares if the stock price moves above my purchase price. One of the most interesting aspects of the stock and option market is that I don't need to buy shares of stock or buy option contracts. I can sell them too, even if I never owned them in the first place. If I sell or short shares of stock, I'm ultimately borrowing shares from the market and selling them at the current market price. I would collect a credit for doing so, and to close the trade, I would need to buy them back for a debit. If I short 100 shares of stock and the stock falls by $2, I could make $200 if I buy the shares back. This is because I shorted the shares at a higher price than I bought them back for. If I shorted shares and the stock rallied $1.50, I would lose $150. Just like owning shares of stock, there is no gray area when shorting shares. The stock either falls from my sale price and I make money, or it rallies from my sale price and I lose money. At tastytrade, we know how hard it is to pick stock direction correctly. A company could have a great earnings announcement, but the stock price could fall. A company could have a horrible earnings announcement and the stock price could rally. Heck, there are companies out there that don't even make money, but the stock price surges day after day. We embrace the fact that we don't know what's going to happen in the short term, and we strategize around that. What if I were to tell you that instead of betting on a stock moving in a certain direction, I could bet that a stock would not reach a certain level? This means I could profit if the stock stays the same, goes down, or goes up, as long as it doesn't reach the price I chose. Intriguing, right? This is what options offer us, a world of gray area where we can create ranges of profitability rather than needing a stock to move in a certain direction. Trading options isn't just a 50-50 bet on the stock price. When selling options, we get paid to take the risk of a stock reaching a certain level, and if it doesn't by the expiration of our contract, we keep 100% of the premium we collected up front. Options offer us flexibility from a time and strategy standpoint, which is why we choose to trade options over stock. Even if we do own shares of stock, we can create strategies around that to collect premium, reduce our cost basis on the shares, and open up a window to be successful if the stock price stays the same or even goes down a little bit. To see more options explainers, get daily trade ideas, or to join our community of like-minded traders, click the subscribe button here.
Striving to reach the ultimate goal of zero. Incredibly focused on how do they get their clients convinced to stay with the bank. You know, they talk a lot about how early October they had a lot of client outflows. Clients were worried about the stability of the bank. That may have been, you know, spun around by rumors on social media, but there's a lot of questions surrounding, you know, will this bank actually serve my needs as a wealthy client, especially if the investment bank, we don't know exactly what this First Boston unit is going to look like, how much is going to actually feed into the Credit Suisse business that remains. So a lot of question marks that they'll have to answer in the next 2 years.
Marion, is there a space for a wealth management company, bank like Credit Suisse? And actually, again, going to your point, is like, what's the value proposition? Is it in execution, or is it really in the business model that the chief executive needs to convince people to stick around and get more people to join?
There's definitely room for a big wealth manager like Credit Suisse. I mean, they've been a wealth manager for the last, you know, half decade alongside UBS, Julius Baer, Morgan Stanley. And let's not forget, they do have a strong presence in Asia and some of the emerging markets, including Middle East. So that is definitely an interesting proposition. They still have the Swiss branding, so that will still be attractive to clients, and clients will want the option to diversify across different banks. So having Credit Suisse out there as a wealth manager is important. That being said, you know, how much they can do in terms of offering tangential services like IPOing a wealthy client's business, we'll have to see how that works out. I mean, obviously Julius Baer has that model. They don't have their own investment bank, so they are often, you know, advising, helping clients out. UBS still has that in-house, so we'll see how they play out.
Marion, what do we know about this possible, you know, investor into the First Boston spin-out? I mean, first of all, it's really a blast from the past that they call it CS First Boston, and who could come in and support that?
Look, they've been talking to their existing investor base. They're talking to outside investors as well. Obviously, you saw that Michael Klein, one of the board members, who's a former Citibank dealmaker, is going to be leaving the board and running that business. He has very strong ties to the Middle East, so we might see some Middle East sovereign wealth funds come in, who are also some of the shareholders of Credit Suisse, or we might see other parties that we haven't seen named yet. It's to be determined. Those conversations will be happening. First step, they do actually still need to figure out how to separate that business into a separate legal entity first.
Yeah, this is what we're hearing is really, you know, steps by steps by steps. And we just had the first one today. Marion, as always, thank you so much for great insight, great reporting. Our finance reporter based in Zurich, Marion Haltefmeyer. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. US Secretary of State Antony Blinken has accused China of trying to speed up its seizure of Taiwan. Blinken told Bloomberg China's undermining the decades-long status quo that has kept it from going to war over the island. Beijing said on Wednesday that China is closer than ever to realizing complete reunification of the motherland.
What's changed is this: a decision by the government in Beijing that status quo was no longer acceptable, that they wanted to speed up the process by which they would pursue reunification.
Now, Iranian state media are blaming Sunni Muslim extremists for mosque attacks that killed at least 15 people in the southern city of Shiraz. The attack came as protesters marked 40 days since a woman's death in police custody, which has ignited some of the biggest anti-government protests in a decade. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg Francine.
Leanne, thanks so much. Coming up, the ECB decides. The Governing Council is due to reveal its rate decision in the coming hours. We're live in Frankfurt next. This is Bloomberg.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one, and through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the US shaped the 20th.
The difference between missed opportunity. For in-house attorneys who strive to provide superior counsel and strategic advice, Bloomberg Law offers an unmatched platform of analytics tools and business intelligence. All to help improve productivity, mitigate risk, and inform decision-making. For the comprehensive platform that helps you work smart.
Matt McNeely is a shot back as he comes to the 18th here in Pebble Beach.
When I have a chance to win a golf.
The difference is Bloomberg Law.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition on Francine Lacqua here in London. Now, the ECB expected to deliver another supersized rate hike to combat runaway inflation as members of the Governing Council meet today. Joining us now is Bloomberg's Maria Tadeo, who's in Frankfurt for us. So, Maria, what exactly are we expecting today? A rate hike and...
Yes, and that's a very good way to put it, because Francine, when it comes to the rate hikes, is very well calibrated, very well guided by the Governing Council that we're expecting today, 75 basis points. Of course, that takes the deposit rate to 1.5%. There's a lot of perhaps suspense in terms of the signaling going into the December rate hike, but in terms of today, it is pretty much a done deal. This is 75 basis points. What's not a done deal, and this is really where every ECB watcher that I've spoken with this week will be focused and paying attention to, is the tilters. What to do with the cheap funding that is still doing the rounds in the Euro system. Remember, Francine, to some extent, this is becoming a headache for the European Central Bank. They want to begin at least to talk about this idea of draining the excess liquidity from the system. But also when you look at the arbitrage going into this, it could look like you're also providing essentially, well, a subsidy to banks at a point in which for a lot of Europeans, this is a cost of living crisis. Politically, not a good look. There's still ways to change it. We've talked about this reverse tier, the reserve management, potentially just changing the terms altogether. Of course, that implies litigation risk to some extent, but this is really the big unknown going into this. And I've been told in that press conference, potentially the issue that will dominate.
Yeah, potentially, of course, one thing that we need to watch out for. Great reporting, as always, our Maria today there on the ground in Frankfurt. So now we're joined by Stephen Bell, Chief Economist, EMEA at Columbia Threadneedle Investments. Stephen, what are you looking for? Actually, what Christine Lagarde will say today.
Well, we want to know about the future.
We do.
We're going to hear about what they're going to do today. We'd like to know what her assessment is about the future inflation pressures, the future outlook for the economy. Lots of people concerned about recession in Europe, these sky-high energy prices, even though they've come off a bit.
On inflation, do you think actually we could have reached peak? So we have warmer weather, we're seeing demand for a lot of gasoline and gas products in Europe dwindling.
But one of the points I make about European inflation is that more than half of it is food and energy. In the United States, most of it is domestic. So although wages have picked up, rents have picked up, the fact is those domestic pressures are weaker. So you could, given the outlook for weakening economy, argue that the inflation would come down of its own accord.
So with the Eurozone weakening, do you think this is the last 75 basis point hike we get from the ECB?
Maybe, yeah, maybe. I mean, I think what's interesting is how Christine Lagarde has, in a sense, led the way on these rate rises. They haven't been pushed into it by the market. And we've seen the mistakes the Federal Reserve made. She said, you know, I'm avoiding an easing of monetary policy. That's how she introduced this concept at the beginning of the year. And actually, with the exception of the problems that Italy has faced, because, you know, rates go up in Europe and they go up even more in Italy, bond yields, creating a potential risk to the fiscal side. That's still a big challenge. But for now, I think, as you say, the warm wind, as we certainly know here in London and most of Europe, is easing those gas prices, easing the risk of recession. But it's still there. Lots of industries, particularly in Europe, can no longer survive.
Yes, and we don't know, and we also don't know where we'll be like December 5th or December 6th.
Exactly.
Right? We could see a huge downturn with like gale winds, and we all need our heating up again. Give me a sense of what we heard from Giorgia Meloni, the new prime minister in Italy, and she was really pushing back against interest rates. We heard similar comments actually from the French president as well. What should the ECB do about it?
Ignore them. I mean, they are independent. They are about the most independent central bank in the world. It was constructed that way.
Yeah.
And, they don't have to kowtow to politicians. So unlike almost every other central bank, one way or another is under the control of the government. But this is independent. Yeah. And the point about Giorgia Meloni is that she now has to take money from the European centre because she doesn't have the fiscal space to cope with these very high gas prices. Northern Italy's cold place. It's not all warm in Italy. So she can now benefit, in a sense, by borrowing a lower rate from Brussels than she'd have to pay on the bond market. So in a sense, there's an opportunity there for her to slightly ease her words, because they're not grants she's getting, but loans. So yeah, she doesn't want higher rates, but that's not her call.
And I think there's a list still of like 15 things that needs to get done before they get the next tranche of money, which is in December. Talking about QT, when are we expecting QT from the ECB?
Yeah, that's another good question. I would say they'll be doing it towards the end of next year. They'll be giving us a clear schedule for that. Yeah. And that will be obviously a big change. And you've got a list of things you said earlier that they were doing in terms of other areas of support. But now they're moving towards regularizing monetary policy.
All right. Thank you so much, Stephen Belder, Chief Economist, CMA at Columbia Threadneedle Investments. Now we'll get to some really fun stuff, and let's talk about the UK, because we've had quite a roller coaster on the UK economy in the last 6 weeks. Coming up, a £35 billion black hole. That's an estimate of the gap the UK needs to plug in its tax.
We should be more sustainable. Amazon Business can steer us toward more sustainable products. I feel good. What's next?
It's a car that runs on positive vibes.
I love people.
Amazon Business, partnering with enterprise leaders for smart business buying.
Spending plan. So we'll discuss that next. This is With Us.
Okay, this is going to sound a little nuts, but the fastest and easiest way to make passive online income on Amazon is to...
much of a push have you seen from the Kishida government in terms of green funding? The Kishida administration has committed to doubling the amount of investments in so-called green technologies. I think we need more than just pronouncements. We need real money backing very innovative startups now.
Let's see what this market does. Boom, we're gonna be going all the way from what a candlestick chart is to indicators, support and resistance, trend, all the way to entry patterns and how to take stops and targets. We're dissecting everything today. In this video, I will be pouring all the knowledge about technical analysis that I have gained over the past decade of my own trading career into one video. And since I'm doing that for absolutely free, it would be awesome if you could just smash that like button for me to help out with the YouTube algorithm. If you are new, go ahead and click that subscribe button because we come out with content like this each and every week. If you're already subscribed, welcome back. You know what's coming. I'll see you after the intro and disclaimer. So I'm going to say this really slowly so that anybody who is brand new will easily understand. Technical analysis is the study of historic price movements in order to make accurate decisions of what the market may do next. Technical analysis is how we make those accurate decisions of what price may do next. Every part of technical analysis is based around price. Think about a candlestick chart. That's just a visual representation of price itself. Trends are nothing more than higher highs and higher lows, or lower lows and lower highs in price. Structure, support, and resistance, even indicators, are based around price. They're just a formula added to historic price data in order to plot that indicator on your chart. So because of the fact that the foundation of all technical analysis is price, the very first thing we're going to study today is a candlestick chart. And I'm going to put a timestamp beside me of the 7 or 8 things we're going to be going over in today's video. That way you can skip ahead if you already know parts of technical analysis. With that said, let's go ahead and dive into candlestick charts. What you see on the screen in front of you is known as a candlestick chart. Right now, we are on a daily chart of the S&P 500. I'm going to go to a price chart of Bitcoin. Now we are on the daily chart of Bitcoin. And now let's go to a candlestick chart of the euro dollar. Now, what do you notice about all three of these? They all have candlestick charts. So the foundation of technical analysis, no matter what market you're trading in, whether that be Forex, stocks, crypto, the foundation of technical analysis in every market are these candlestick charts. But before we can understand this full candlestick chart, first, you need to understand what a single candlestick represents. So let's do that now. Here are a couple of single candles. And what these candles represent is price movement throughout a certain period of time, depending on the time frame that you're on. I'm sure you've all heard of time frames, right? The daily chart, the 1 hour chart, the 5-minute chart. Depending on what time frame you're on, that's the amount of price movement these candles represent. So let's consider that we are on a 5-minute chart. That means that each of these candlesticks would represent 5 minutes of price movement. Now, before I get ahead of myself, candles have 2 parts. Candlesticks have a body, which you can see here, colored in green, and a wick, which are the lines above and below the body of the candle. A green candle represents a 5-minute period, since we're on a 5-minute chart, right? A 5-minute period where price went up or closed above where it opened. We're going over that in just a second. A red candle has a body as well, but the body of this candle is red because it represents a 5-minute period where price closed below or went lower during that 5 minutes. To make this really simple, let me go ahead and explain the open, high, low, and close. The open of a candle is where it opened during that 5-minute period. So let's say that the beginning of our candle is at 12 o'clock. What this candle would represent is the open of a candle at 12 o'clock. The low would be the lowest point price got to during a 5-minute period. The high would be the highest point price got to during a 5-minute period, and our close would happen at 12:05, and that would be the ending price during a 5-minute period. So that is a green candle. A red candle represents when price went down during that period of time. So for a red candle, we would have an open at the top of the body. This is the only difference between the two candles. The open is at the top of the body of a red candle because during a red candle, it represents a period where price closed below where it opened or went lower during, let's say, a 5-minute chart. So the open is there. The highest point is the same. It's the top of the line or wick of the candle. That's the highest point price got to within 5 minutes. The low is the lowest wick on that candle. That's the lowest point price got to in 5 minutes. And the close is the closing price after 5 minutes of data on a 5-minute chart. Again, if we started this at 12 o'clock, then the closing price would be at 12:05. And this candle shows you all of price between, all of the action of price between 12 and 12:05 if you're on a 5-minute chart. If we're on any other time frame, everything is exactly the same except for the amount of time that passes. If you're on a 1-hour chart, then this would be the open at 12 o'clock, and the close of this candle would be at 1 o'clock. Everything else stays the same. The low is the lowest point that candle got to during that hour. The high is the highest point that candle got to during that hour. So at this point, you should know exactly what each and every candle represents, and we put a large amount of these candles together in order to interpret what price is likely to do next by identifying trends and areas of value, identifying entry patterns, which is all stuff that we're going to go over right now. So let's dive down to a chart, take a look at a couple of live examples of single candles, and talk a little more about trend, areas of value, and the way we can use candlestick charts to predict what the market may do next with a high degree of accuracy. Just as a quick look at candles on an actual chart, we are currently on the 1-day chart of the Euro New Zealand. So what do each of these candlesticks represent? They represent 24 hours of price movement, or 1 day of price movement. A green candle represents a day where price went higher, or a day where the price closed above where it opened, right? A red candle represents a day when price went lower, or a day where price closed below where it opened. This most recent green candle, what does it represent? It represents price opening right here at the beginning of the day. The lowest price that price got to is the bottom of this wick. The highest price that price made during that 24-hour period is the top of the wick right here. And the close of that day is the top of the body of that candle. The opposite is true for a red candle. So now that we have that, let's move on to how we can use a large amount of these candles in order to identify a trending market and make accurate trading decisions. So if you had to take a guess of what trend the Euro New Zealand was in, which is the chart that is in front of you, what would you say? Uptrend, downtrend, or consolidation? Hopefully you were able to say an uptrend. And simply put, an uptrend is nothing more than when a candlestick chart is consistently making new highs and then higher lows, followed by new higher highs, new higher lows, new higher highs, new higher lows, new higher highs, new higher lows, and so forth. This higher high and higher low situation is what is referred to as a trending market. And this particular situation would be an uptrend. Now, the reason we utilize a trending market is because it gives us more accuracy on our trades. You've probably heard follow the trend before. And most beginners will gravitate towards trend trading for good reason. Again, it adds accuracy to your trades. It can make for better reward to risk setups. And all in all, it's much easier to ride a trend that's already there than to pick the very top or the very bottom of a market trying to trade reversals. So it's a good thing to trade with the trend. With this market being in an uptrend, what direction would you like to trade this market? To the upside, right? You'd want to be buying while the market is in an uptrend. But here's the problem with trend identification that I see all the time. And that is just not really understanding or having a set in stone, objective, defined way to identify trend. A lot of traders can easily identify this, right? That's an easy trend to see. But what if price is acting like price normally does, and it looks more like this? We have our high to low, a new high, but then price does this, and then finally goes up, and then goes up again. At this point, doesn't it get a little bit harder to identify trend? So with that being the case, I want to give you an objective way to identify trend right now. What we have in a trending market are impulsive moves. That is the big moves that break into new highs. Right here is our impulsive move. I'll label those with an I. These are the impulsive moves. After an impulsive move, the market takes a breather. We call that our pullbacks. These are our pullbacks in price. This would be a pullback, followed by our next impulsive move that breaks a high right here, impulsive move, and again, pullback right here. So the objective way that we're going to be identifying trend is the lowest low of the pullback cannot be broken for us to stay in an uptrend. So once we have this move that breaks and closes above our previous high, we call that our what? Impulsive move. Once we have that impulsive move breaking into new higher highs, which is what we're looking for in an uptrend, this market is still considered in an uptrend until we break or close below the lowest low of the previous pullback. So when we get a break above this high right here, when this market breaks above this high with a new impulsive move making a new higher high, then this market is still considered to be in an uptrend until or unless the market breaks and closes below what? The lowest low of the pullback, which would be where I just put this line. This is the lowest low of that pullback. So as long as the market stays above that low, then we're still considered to be in an uptrend and we still want to look for buying opportunities. At this point right here, we have had what? Another impulsive move. This move is our impulsive move because it broke above the previous higher high. At this point, what level cannot be broken for us to continue this uptrend? We cannot see the low of our pullback broken. Where's the low? That's the lowest point price got to in this pullback. As long as the market stays above that level and continues making higher lows and higher highs, then we're still in an uptrend. What we do not want to see is the market come down and break below that previous low of the previous pullback. I know that might sound complicated. We'll do it on a real chart to help clear things up. Also, if it sounded complicated, just go back and rewatch this portion of the video. This is how I objectively identify whether the market is trending up or down. Is going to be the opposite. We'll look at a downtrend as well. But the reason we have to have this information is because we want to be trading alongside the trend of any given market. If this market's in an uptrend like this, do I need to be trying to sell and go short and go against the trend? No, because the likely scenario is that we're going to continue into this trend. We're going to continue breaking into new highs. And just to show you that, let's click play and see what happens. At this point, right now, looking at the chart, what do you expect to happen? What do we have? We have our low, just as we were just drawing it out, to a high, a higher low, a higher high. Here's our higher low right here, our higher high, our higher low, our higher high, and our higher low. We have now done what? Created an impulsive move. What do we expect after the impulsive move? We expect a pullback, but what cannot happen? This pullback after our impulsive move cannot break and close below the low of our previous pullback. This is the low of our previous pullback. So if this market does this, then we're expecting what? A possible reversal. We're expecting this market to possibly head lower. But as long as we stay above this previous pullback, we're still considering this market an uptrend, still looking for buying opportunities. Let's see what this market does. Boom, just like that, we break into new structure highs, continuing this uptrend here on the Euro New Zealand. So that's how I identify uptrends. Let's now switch the script, flip the coin, if you will, and take a look at downtrends and how to identify those in order to make more accurate trading decisions. So if for a uptrend, we are looking for higher lows and higher highs, what do you think we're looking for with a downtrend? It's the complete opposite, right? We're looking for a starting point here, then we're looking for lows, followed by a lower high, followed by a lower low, followed by a lower high, followed by a lower low, followed by a lower high, so on and so forth. And with this being the case, just like with the other example, I'll give you an example on the whiteboard here. if we're heading lower, it's really easy to identify this as a downtrend. This chart, extremely easy. What about when price does what price normally does and we get something like this? And then the market goes like this and gets higher and consolidates and then finally breaks below this low. Well, now, since we just went over this, you know that this is still a downtrend unless what happens? Just like an uptrend, we have our impulsive moves here, followed by pullbacks. What we do not want to see is the market break and close above the high of the previous pullback in a downtrend. If that happens, then we're considering that a possible reversal. But as long as that doesn't happen, then we are still in a downtrend. And what kind of trading opportunities are we looking for if this market's heading down? We're looking for selling opportunities as long as the market continues to head in the downward direction. So that is my objective way of identifying trend. And at this point, you have a lot of knowledge you've gained throughout this video. You now understand candlestick charts. You understand how to identify a trending market, whether that be up or down. So if you've already gained value, why not go ahead and smash that like button for me? And what we're going to do now is talk about how to find high probability areas of value using structure, support, and resistance. See you there. Support and resistance are simply areas in the market that price is likely to react from. Support is an area in the market that price is likely to have a bounce up from or be supported by, whereas resistance is an area in the market where the price of an asset or currency pair or crypto or stock is likely to fall or drop down from. These areas are based on historic price and based on other areas of support and resistance we can see in historic data. And those are based on the decisions of all other market participants. We're not going to dive into the psychology of support and resistance in this beginner video, but these areas of support and resistance are useful for three main reasons. You can use them to spot possible reversals. You can use them as entry points on trend continuation trades, and you can use them to help you determine your stops and targets. So what we're going to do right now is go over a couple of those. As I said earlier, most beginners are going to gravitate towards trend continuation trading. So what I'm going to do is show you how to use these areas of support and resistance to make better trading decisions while in a trending market. And I'm going to go over how to use them to help you set your stops and targets. So let's go ahead and dive into some charts and talk about support and resistance and how they can help us make better trading decisions. Using support and resistance as entry points in a trending market is very simple if we build on what we already know from the previous lesson about trend. If we were to draw out a trending market, it would look something like this. Low to a high, pullback, break above, a little bit of consolidation, not crossing that previous pullback low though. So what are we still in? An uptrend, right? Continuing, then pulling back, continuing up, pulling back, and continuing higher. In an uptrend, the likely scenario, if we're going to continue in this uptrend, and one of the best ways to look for possible support and resistance trades is to look at the previous level of resistance that was broken to become support. This is how we use support and resistance for entry points in a trend continuation model and in a trending market is by using that previous level of resistance as possible support. Let's do a bearish example. In a bearish trend, the trend would look something like this, right? As we go further and further, what we're looking for in a bearish trend is for the market to get back up to that previous level of structure support that now we expect to become resistance. So this is called a break and retest strategy. And what we're looking for with this strategy, again, is the market to break below a previous level of support, like we have right here, come back to that level and provide a trading opportunity. We're going to talk about how we enter trades later on in the video. But what you need to know right now is using structure, support, and resistance for entry levels in a trend continuation model and in a trending market goes like that. And what we're going to do now is take a look at this on live chart data. Here we are on that same Euro New Zealand chart. What did we just discuss? Well, we want to see the trend start. So we have our low to high, higher low, followed by our higher high. At this point, the reason this is our higher high is because this is where the market made a new high compared to its previous high and closed above the previous level of resistance. With that being the case, the previous level of resistance is likely to become support for a trend continuation market, for a trend continuation trade. If we continue looking here, we have a push up, a pullback, a push up to a new high. This pullback, where does this pullback come to? I was to draw this box out right here at our previous level of structure, resistance, and make it a little easier to see for you. What do you notice? At this point, with this trend continuation in mind, the market made a new high with our impulsive move. Comes down to our pullback. Where did our pullback come to? Our pullback comes right into the previous high that was broken. This is resistance turned into support, and this is how we use support and resistance to find entry points in trend continuation. Let's take a look at a bearish example of this now. Here we are on that same Euro-Aussie chart we looked at for the trending model we were discussing earlier in the video. In this case, we have our high, down to our low, up to our high. Once we break below this low right here, what are we looking for? In a bearish trend, after we break that low, we would be looking for a pullback. And let me delete these lines to make it easier to see. Into that low, just as we have right here, and a continuation of the trend afterwards. As you can see, this market pulls back right into the previous area of support. It does become resistance, and this market continues pushing down. This happens over and over again and looks to be happening right now on live chart data here on the Euro-Aussie. Let's draw that out so you have a complete comprehension of how to use support and resistance to find entry points in trending markets. We have our high to our lower high. What happens? We break below what? Our previous low. If we put a box around that previous low, what has price now done? Price has now came back into that previous support level that now is what? It's a break and retest strategy. So if it was support, it's now going to be resistance. So at this point, once we get to that level, we can start looking for entry reasons. Again, we're going to talk about ways to enter the market in these types of situations a little bit later on in the video. But for now, it's just important for you to understand and comprehend that we're looking for breaks and retests of support and resistance levels in trending markets, whether we're trending up or down. That shouldn't have been too hard to comprehend, but if you had any trouble, rewind the video and watch that section again. Now let's talk about how to use these levels for possible targets. Let's go back to a bullish example. So for a bullish example of this, let's say that you got a entry in this area on a lower time frame. Let's say you dropped down and you saw like a double bottom or something in this area. If that's the case, then the way we could use support and resistance for possible targets is this level of support, this box that we drew. We definitely want our stop loss below that level. So with that being the case, we would make sure that our stop is below that level, keeping us safe. In terms of what we can expect out of targets, the way we use this to prepare to take those targets is if we're expecting trend continuation. And before I continue, do you see how everything's coming together? We learned about trend in the last section. If your pullback has not broken below the low of the previous pullback, then what's the likely scenario? That we break above these highs, right? Into new highs and continue in this uptrend. With that being the case, what if you said, well, the way I'm going to take targets on this trade is by looking at the previous high and taking my targets there? Because the likely scenario is that this market continues higher. So then you would place your targets based on this resistance level right here. And that is how you use trend and structure in order to give yourself good reward to risk ratios and accurate trading opportunities. In this case, would have been about a 3.6 reward to risk ratio on this trade. My camera literally just died on me, but I have an extra camera, so no worries. Let's wrap it up with a recap. For a trending market to the upside, what we are looking for is a level of resistance to break. And then we're looking for the pullback after the break of that level of resistance to come back to that level of resistance. We're then looking for that level to become support in an uptrend and in a trending market. For a downtrend, we are looking for quite the opposite. We're looking for a level of support to break and then the market have a pullback that comes back to that level of support. We're looking for that level of support to become the likely area of resistance for the continuation of that downtrend. In terms of stops and targets, we're using these levels to make sure our stop loss is beyond that level of support that we point out or that level of resistance we point out. And we want to look left and make sure our targets are not close to a level of resistance for a buy trade or not past a level of major resistance, because that level of major resistance may push the market down. We want to make sure we take targets or at least roll stops to break even before the market gets pushed down by that level of resistance. The opposite is true in a downtrend with a level of support. If you're selling, you want the market to go lower. You don't want to be beyond a level of support. So that wraps up the support and resistance lesson. Next up, we're going to talk all about indicators and how they.
All right, you guys, I don't want to overwhelm you. Thanks for tuning in. I'll be back on a little later this morning. I just wanted to get some training in since I was up. And so I'll wait till the market opens a little longer, maybe about 7:38. I'll come back. So digest that. I put the link to this video in the chat. You can go and review it. Get yourselves a paper trade account. So when you're identifying some charts that you would like to participate in, start to trade one way or the other based off what you're learning, then guess what? You could do it in the paper trade account and you won't lose any money. And you could practice and make mistakes, and then you'll be able to ask very beneficial questions to you, questions that are relevant to you based off your paper trading. All right, Psycho, thanks for interacting with me. Peace, you guys. I'll see you probably in a few hours.